So let's start with credit. What really is credit? It's basically just your ability to be able to borrow in the future. It can be useful in times of emergencies, and it can allow you to make larger purchases. So your credit history, it's really not rocket science, but it is a little bit like having fuel for your car. If you try to put diesel into a regular gasoline car, it's not going to work, right? So your credit score is what you put into it is what you're going to get out of it. And that's what I like to tell people, because some people will come in and they don't have their credit established, or they've had some bad payment history in the past, and they're coming and wanting to say, well, why is my credit the way that it is? It's what you put into it. That's what you're going to get back out of it. And as much as it might have been easy to get into that, it's a little harder to get out of it. So that one late payment or that missed bill when you moved away and didn't catch up on things will haunt you. It'll stick around for a while. But the thing is that you're the one that's in control of that. You're the one that can fix it. You're the one that got it to that point. So what actually goes into your credit score? You can see from the pie chart that your payment history is actually the largest part of that. So that's basically how have you paid in the past is how a lender feels you're going to pay going into the future. Okay? So part of that, the second part of that is the amount that you owe. And that's actually the one that you can have the most influence on making your score go up the quickest that you can. And what I mean by that is it's best if you have several accounts that have a smaller balance rather than having a few accounts that have a larger balance. So you don't owe any more or less in either example, but you're spreading it out. So the rule of thumb to increase your credit score the quickest way is if you owe less than 10% of your limit. So if I have a $500 limit and I only owe $100, that's going to look better than if I owe $400 and still have that $500 limit. Now what's happened to people recently with the credit crunch that we kind of went through starting in 2008 is financial institutions and credit card companies got really nervous about people having these really high limits out there. For a while people paid, and so they kept raising their limits. Congratulations, your limit's now $3,000. Whether you actually used that or not didn't really matter to the credit card company. You were paying as agreed, so they were going to keep increasing you. Well, they got a little nervous about that, and so they started backing it down. So if your average history with them was, the most you ever had with them was $1,500, they brought your limit down from $3,000 down to $1,500. Now, if you owed that $1,500, before it looked like you had a limit of $3,000, so your balance to your limit was a lot less, and so your credit score was okay. Now they brought your limit down to $1,500 and you owe $1,500. What do you think that did to people's credit scores instantly? Brought them down. And it could bring them down 10 to 15 points depending on how many credit cards that they had out there. So the next piece of the pie is your length of your credit history. And that's just how long have you had that credit out there, that trade out there. And sometimes people will tell me, well, I closed that card because I got another card in the mail that was 0% interest for a year. And so I switched my balance from that one to this one and I closed that one out. Well, what you did was you replaced an existing, maybe long-time credit with something that was brand new and now doesn't have a history to it. So it doesn't connect the two together and pull it together. So it looks like that's just a brand new credit. So that's what it means by length of credit. So sometimes I would tell people it's okay to go ahead and transfer that balance to that lower card, but go ahead and keep that old one. You don't have to use it. Maybe you just use it periodically and pay it off. But it will be better to have that in your wallet or your purse to help with your credit. New credit, and that just means just what it is, new credit. Anytime you apply for new credit, it's probably going to bring you down a couple of points just initially because it needs to build up that time frame. Your types of credit in use. So if you have just all credit cards, your credit history is going to look different than someone who has a couple of credit cards and a student loan and a vehicle. Not necessarily in a bad way, it's just the model will look at all the different types of credit that you have. So the score is actually called the Fico Score, and it's just named after the company that created it. But you can see from the chart where you might rank. But what I want to share with you is you can see that 13% of the population have a credit score of 800 or above. But what I wanted to share with you that's not up here is the delinquency rate that goes along with that. So that's how likely are you to pay your bill or not pay your bill. So if you have a credit score of 800 or above, the delinquency rate for that is only 1%. Okay? 750 to 799, the delinquency rate only goes up to 2%. 700 to 749, it goes up to 5%. You get in the 650 to 699 range, and it jumps up from 5 to 15%. You go to 600 to 650, jumps from 15% up to 31%. Go from 550 to 599, goes from 31% up to 51% of people will default. 500 to 549, 71% of people will default in that credit score range. And then 499 or below, 87% of the people will default in that range. So you can see why your credit score is important. Not only is it going to play into the fact that will you get the loan at all, it'll also be built into your interest rate. Lenders now are doing what's called risk-based pricing, which means that they look at what's the delinquency rate for where you fall. So you may get that loan, but you're going to pay more for it. Okay? So I like to think of the credit score kind of like your grade point average. What you've done in the past in that class, so the first test that you took in that class has a factor on your overall grade for that class, right? So it's just like your credit score. But as more assignments come in and more things come in, you can overcome having a bad grade on a test. It's the same with your credit score. The more that things go into the past, the less emphasis that they'll have on your overall score. Let's talk a little bit about budgeting. And, I think budgeting is kind of one of those hard subjects to talk about because people go, budgeting, not really exciting. But what I wanted to tell you guys is you guys are already budgeting. Whether you think you are or not, you already are. You're budgeting everything. You're budgeting your time. You're prioritizing things that you do. You're making decisions when you go out, whether it's to buy a cup of coffee or have that cup of coffee at home or have a friend buy that cup of coffee for you. You're making all those kind of decisions along the way. You're budgeting your time when you're picking out your classes, deciding on a work schedule. And basically budgeting, all it really is just being able to track where you're currently spending your money and where you want to be able to spend it. Share a little story with you on the propane side of things. Propane went from historically about $1.69 a gallon up to $4 and $5 a gallon. Do you think that had an impact on people's budgets? Tremendous. I mean, nobody plans, no matter how good you are at budgeting, nobody really plans to spend 5 times the amount that they normally spend to heat their homes or to cook their food. Luckily there are programs out there that were able to help people, but those that were in a better position were ones that at least did budget for what they normally would spend, and we as a company worked with them to, how do we budget the rest of that now then? Because that balance is still out there and still going to be due, so now we have to work with our clients then to say, how are we going to budget to get you back on track going into the next heating season? So basically having a plan is a lot of budgeting. You can see up there, it kind of shows an envelope type of system. There's a lot of different type of systems you can use. That's just one of them. Other tools that you can use are just using your online banking. A lot of them build in kind of a budgeting tool now where you can say, put in how much you spend. Some people will use programs such as Excel or Microsoft Money or Quicken. Some people just use a calendar, whether it's, a calendar on your phone or just a paper calendar to write, car insurance due on the 15th. And then it's a visual reminder that I better have $150 to, make my installment for my insurance. Checkbook ledger and monthly statements, I don't see those used as much anymore. The envelope method was the one that was up there. And that's simply taking that $150, putting it in an envelope and putting it away so that when that bill comes due, you can just pull it right out and pay for it. Yes?
So I always like to tell the story. I started the envelope system probably about a year ago now, and it's working really well for our family. We weren't doing so well as far as spending using plastic. And there's research out there on spending cash being affiliated with the pain center in your brain.
Yeah, it has more of an emotional connection to you because you see it.
And you're handing that 20 over instead of a piece of plastic. That doesn't feel like anything. And then pretty soon you get to the end of that month and you say, what did I put on my credit card? I had no idea that I did that. So now having this cash, and I'm like, sure, I'll just try it. It is. I save more money, I hoard more money, my spending money, because I don't want to give the 20 away.
Yeah, you physically have to give it away. A lot of times my kids will say to me, well, I have money at home, can't you just get that for me? And I'll say, nope, I don't have the money for that. And they'll be like, well, you have that card thing, don't you? And I can just give it to you when I get home. And I will still say no, because I want them to have that same kind of reaction. Like, will you be as quick to spend this if you have to physically bring your own money and hand it over? And now it's gone. It's different, handing it to me at home. Will I remember, and those kind of things. So, borrowing $3,900 will take you 35 years to pay it off at just the minimum payments. You would actually have spent $14,000 by the time you paid that off. So you should see that information right somewhere prominently on your credit card statements now, showing you, if you make that minimum payment, it's going to take 20 years to pay that off, 15 years to pay it off. And they may even have some examples of if you paid off in 5 years or 3 years, just to give you an idea. Okay. So sometimes people will say to me, well, based on my score, that depends on whether I'll get it, right? No, there's other factors that come into it because, again, like I said, lenders are going to that risk-based pricing, so they may still lend to you. If you have a credit score of 600, you just might pay more for it. And, if we've known that you've always been consistent on, maybe you're making $50 savings every month to your account, we can see that. That builds into that character piece of it. Of course, credit score will haunt me forever, and we already kind of talked about that yes, it'll haunt you for a while, but the more time that passes, the less emphasis that will have. My score will drop if I apply for new credit, and initially it will because that goes into that new account bucket of the little pie chart, but it won't drop a whole lot. You're talking maybe 5 points at the most that would drop. And sometimes people think it will drop if they go car shopping or looking for a house, but there's actually a provision in there that if you're looking for a car and you're shopping around, so you go to a car dealership, and a lot of times they'll try to find the best interest rate for you, so they'll send your loan application to 5 different lending institutions to try to get you the best interest rate. Each one of them is pulling your credit report when they do that because they need their own information to base on. But that's only counting as one request for you, because there's a 30-day window whenever you're doing shopping like that it only counts as one inquiry into your report. Some other myths. When I pay, bad credit will go away. Credit that is out on your account actually stays out there for a 7-year time frame. And if you have a bankruptcy, it actually stays out there for 10 years. So, but again, the longer that history is away, the less it will impact. The other thing that people sometimes don't understand is if you find out something's on your credit and you pay it off, you kind of started the clock all over again with that particular creditor. So say it was 2 years, it was an old cable bill you didn't even know about, you had moved away, and you find out about it 2 years later and you pay them in full. That's going to be out there from 7 years from that active date, not necessarily 7 years from when it was put out there. The credit reporting company denied me credit. The credit reporting agency is just information. They're just information data gatherer. The one that, if you get declined, it's actually that particular institution that has declined you. They've made the decision not to take that risk. Requesting your own credit report and pre-approved offers harm your credit score. Those kind of fall into that same category as that car shopping. When you get your own credit report, they can see that that's you obtaining it and that's not a hit against you. And if you get a pre-approved offer that, you know, you're pre-approved for $500, that is something that a company's actually purchased. They purchased a list of people in a certain credit range or a certain demographic that they want to solicit. And so again, that's not going to be a hit against you. There's only one credit score and it's on every report. Not the case, there's actually 3 different credit reporting agencies. That actually there's 4. There's an additional one that's not as very well known, but that's actually where your student loan payments are getting reported to. And creditors will check that, but it doesn't usually provide a score. But there's 3 other major ones that will provide a score. And they can have the slightly different models, different information might be reported to them, but generally they should be within 10 to 15 points of each other. If I have bad credit, a cosigner will help. So go back to that example of those people that were 4 or 5 months behind on their mortgage payment. A cosigner would not help them because a cosigner doesn't help the fact that you have bad credit. A cosigner will only help if you have limited credit because you don't have that history. Okay? We don't want to rely on that cosigner to make the payment, and that's what we would feel like we would be doing in that other instance. Let's talk a little bit about identity theft. And you guys, yeah.
Are you going to share with them where they can get that credit?
Yes, I actually think that might be at that very end of the PowerPoint. There's actually 3 if I have the phone numbers. If I don't, I can email that out. Identity theft, you guys may have heard recently about the Target card breach, where Target had information that was stolen on people's credit cards, and then those cards were listed out. Another story that I'd like to share with you is right after I was here one of the semesters, I was leaving for Chicago with a couple of friends and our daughters. And as we were returning, we were riding the bus on our way back. We were sitting towards the back, and we had all our shopping bags, and everyone's chatty and getting ready to go on the train. And there was a gentleman that had got on after us and sat kind of towards the back directly in front of the door. And I kind of was thinking to myself, well, that's kind of strange. He must have to get off in a couple of stops. That's why he's, because most of the bus was pretty empty. It was one of the double ones. And he sat in the back by us. And I just thought, well, he's got to get off soon. Well, what we didn't know was that he helped himself to one of the pocketbooks of one of the ladies who had her bag kind of behind her because he was sitting directly behind us as we're getting off the door. So within 15 minutes, there had been $300 worth of bus tickets bought. Redbox was used to the hilt. There were train tickets that were purchased. This is all in a 15-minute time span, just long enough for us to get off the bus, get to the train station, and look for the tickets. She couldn't find her tickets. And just in that time frame. So it can happen so fast. And it was right after I had been here, and I was like, oh no, to be a victim like that. But it can happen to anybody. I just want to talk a little bit about that and how you can kind of protect yourself. Identity theft is where, a thief gets some part of your information. Now, sometimes I have people saying, well, I write checks every day. There's a lot of information that goes out just when I write a check. And you're right, your account number is on there, where you bank is on there, but you don't have to give them additional information. We used to always have people put their driver's license numbers on their checks. We're actually recommending that you don't do that. It's more of a hassle maybe when you're checking out because they're going to ask to see your driver's license. But that's a good thing. They're matching up those 2 pieces of information. So the more information that you don't have out there, the better off you are. And they use it without your permission to commit a fraud. So there's what types of fraud are out there. The biggest fraud is that credit-related fraud, like the Target breach. Other identity theft, whether it be medical, insurance, someone obtaining something saying that they're you. Government document fraud, and that can be like someone diverting your IRS check into their account, or Social Security, disability check, or something like that, diverting it. Employment fraud, you don't see that as much. Phone and utilities fraud, even less. And bank and loan fraud, you can see is pretty small. Because we're pretty diligent in making sure that who we're lending to is the person that they say they are. We have a lot of checks and balances in there, which I think keeps that down. So how do they get your information? They can get it from such things as trash, or like in our instance where they just help themselves to the pocketbook out of the purse. They can steal it out of your mail. Conversations that you have in public. You know, you're talking on your cell phone and you're really not paying attention to who all's around. You know, you give a lot of information out. Through the telephone or email, there's something called phishing. We had that just recently actually at the bank where people were calling us and saying, you know, I got a call that my debit card was locked up and I needed a call to reactivate it. They were just asking me a lot of questions and I didn't feel comfortable with what they were asking me. And we really encourage people to do that, because if we as a lending institution call out, we have your numbers. We're not going to ask you for that type of information. You should never feel uncomfortable if your bank calls you. Sometimes I will have to call people on fraud and say, you know, there's a transaction coming through your account from Georgia. And they may say, yeah, I traveled there. It's probably just, you know, something that hasn't hit my account yet. Or, you know, yes, I did make a purchase from Japan, you know, but we have fraud blockers that kind of come in and filter that information. But my point is, I'm asking the questions. I'm not asking them to say, well, you know, tell me what your account number is, and let's verify that all your transactions are correct. So, loan and credit applications, again, you can see that that's not a high area, and there's been a lot of protection, privacy-related wise, to protect you from, you know, places that you do business at, your information. A lot of the Social Security numbers now are truncated. Before they weren't. Your Social Security number was on tons of documents. When I went to college, that's how they posted our grades. Was you went and you saw where your Social Security number was, and there's my grade. So that's probably dated. Hacking into your computer, or any computer, that's what happened with the Target breach. They were able to hack into their merchant service area and get all that information. Stealing a credit statement, completing a change of address. So again, that's a big area too. When we get an address change at the bank, you know, we usually want to talk to people in person and verify some other identifying information before we'll change an address. So what happens if you don't budget? No one's, you know, holding you hostage saying you have to budget or you will not get through life. But what if you don't? What are some things that can happen if you don't? You can incur overdraft fees through your bank. If you know, have a debit that goes through that there's not enough funds for, or you write a check there's not enough funds for. On average, those are averaging about $35 a piece now. So those can add up in a really quick hurry. Most banks will have a limit per day, but it's about 4. So you'll be spending over $100. You could potentially be spending over $100 in a day. Late fees on a trade, whether it be a credit card or your car payment, those average about $10 to $30 for missing that payment going outside of the grace period. Damaging your credit. I had a couple that came in to me yesterday actually that wanted to refinance their house. They were having a little bit of financial trouble. Usually what I tell people is the time to come and talk to your banker is at the very first sign that something's wrong. You know, whether it's someone that loses a job. This particular gentleman worked for a construction company, and when construction took a downturn, he went from working 50 to 60 hours down to working about 25 to 30. So his income went from $50,000 to about $30,000. And again, that has a significant amount in what you're able to budget per month. But the problem was they were already 4 to 5 months behind on their house payment. So the damage to their credit was already done. There's not, they're asking me, well, could I go to XYZ and maybe they can help me? And the answer is no. I mean, when you get to a certain point, there's nothing that anybody can do to you, for you. And so I encouraged them to go and talk to their current lender and work with them. Of course, they were kind of butting heads because that bank wants to get paid and they can't make the payment. And so they have to come to terms of where they can do that. But the damage was already done to their credit by what they had done. If they had come in and talked to me, right when he had lost his job, hey, I think we're going to have troubles doing this, we could have maybe restructured things and amortized it out over a little bit longer period so that the payments were more comfortable. Instead, what he had done for those 4 or 5 months was pull out of his retirement account until he couldn't pull out anymore. And so he was stuck. Not having an emergency fund. So if you don't budget, you don't have anything extra left over. Everything's going out. You don't know where it's going to. It's hard to be able to pull something back or say, I'm really spending too much on my entertainment fund. I have this wedding coming up in a couple months. I want to be able to have something so that I can stand up in that wedding, or there's a great buy on this TV, or, oh no, I have this car repair. You don't have any of that if you don't end up budgeting for just kind of that miscellaneous, that unknown. So how do you build credit? A lot of young people come in and they say, well, you're telling me I need credit to get credit, but I can't get credit, and so it's this big circle of things. But there are things that you can do to start out with credit. You can be what's called an authorized signer on someone else's account. So that would be where you're on somebody else's credit card or loan and you're able to make purchases and they show that will report on your credit report that you're an authorized user of that card, and it'll help your score. Getting a small credit card, if there's a gas station that you normally go to or a clothing store, they typically will only do a small limit, maybe $300 to $500 at the most. So that's a good way to get started. Being co-signed on a loan. I have a lot of people that come in, they go, well, I don't want to inconvenience so-and-so to co-sign with me. And it's really not a problem for you as long as you pay as agreed, because what happens with that co-signer, if you don't make that payment, you go immediately to that person and say, we want payment. So that's why a lot of times people are hesitant to co-sign on a loan as well. There's another type of credit that's called a credit builder loan, and that is basically where you take your own funds. So say you have $1,500 in a savings account, and you say, I would like to take a $1,500 loan out against my own funds. So what ends up happening is it's basically a secured loan. So you're still paying that loan back out over, say, a year's time in increments, but you still have your money. What we usually do, we'll pull it out and put it into a certificate of deposit. So it's kind of a nice win-win because you still have your funds, you're earning interest on that, you're paying a little bit more interest on the loan, but you're able then to build credit, and there's no risk on either side. So what can you expect when you look for applying for a loan? There's usually an application. We look at what's your proof of employment, how are you going to repay the loan? What do you offer for the collateral on the loan? Is it a car? Is it a certificate of deposit that you have? Do you have a down payment? And then what other banking relationship do you have with that institution? A lot of times people will come in, especially if they don't have a lot of credit history, coming into a brand new place because you just want to shop around for the rate, you're probably going to have a harder time than if you stick with the bank where you already have established a checking or a savings and had that history with them because they know you. Because what a lender looks at is what's called the 5 C's of credit. One is capacity, and that's your ability to repay. How are you going to repay the loan? Sometimes people will say, well, I'm going to get a tax refund in April. That's how I'm going to repay the loan because I'm not working right now. Well, there's nothing that says you have to bring that tax refund check in or deposit into us. So we can't really use that as a repayment source. Repayment source is something that is steady and continuous. We'll look at your credit. So what is your credit score? capital, and that means how much you have in assets above and beyond what you want to borrow. Collateral, so what are you offering to use? The house, a car, a certificate of deposit, and then character. So character is the one that's a little bit harder because that is you as an individual person. How have you shown that you're going to keep how have you kept your checking account? Have you had overdrafts in it? Have you, when some banking personnel has called you, have you returned their call promptly? How long have you been on the job? Have you had 5 different jobs in the last 6 months? So that's not showing that you're very stable. So those are things that all build into your character. So how do you use credit wisely? I just wanted to give you just one example. These are very small numbers, but just to kind of give you an idea of, let's use the example that, you got your first real job. It's Friday already. You need to start up Monday. So you don't, you need to go out and buy a couple suits, buy a couple pairs of shoes so that you look presentable. You don't have time to save up for that, okay? So out of $260, the first example I want to show you is just paying it off in 3 months. And again, this is just very simple budgeting, dividing that payment out by those 3 equal installments. You can see that in that instance, you'd only pay $5.41. Okay? And then in the next example, 6 months, again, just kind of simply dividing it out by 6 months, you can see you only pay $12 in interest. So there is a time and a place for credit, but what most people get tripped up on is, say, month 3, that car breaks down. And now I have nothing budgeted to make that car repair payment, so now I was going to pay the $50, but maybe now I only pay $25. And I don't catch it up the next month, I just go back to my $50, or, now that friend's wedding comes up in month 5, and so I don't think I can pay anything then. I'm just going to pay maybe just a minimum, then I have to pay, maybe I have to pay $10. I'm just going to pay that minimum. That's what gets people into trouble. If you're going to budget something, you have to be consistent and stick with it. If you make a variation from that, then you need to make a new plan to decide how are you going to pay that off. Maybe it ends up being 8 months, but that has to be your plan. That has to be your goal. So what, again, can you do if you don't have any credit? We touched on a few already. Paying your bills on time, applying for small loans, applying for those little store credits, making a large down payment. So if a friend came to you and they wanted to borrow $500 for a car that they were purchasing, and they said, I've already got $5,000 that I put down, but I'm $500 short, would you be able to lend that to me? You'd probably say yeah. They were a good enough friend. But if they came to you and they said, I need $5,000, I have $500 that I put down, would you be as likely to lend them that money if you had it? So it just shows that good faith. I'm less likely to walk away from that car if I've already put $5,000 into it, right? But if I've only spent $500 and I now can't make the payments, I'm more likely to walk away from that. Getting a cosigner. And the last one is using untraditional credit. And what I mean by that is traditional credit is something that reports to the credit bureau every month. Those are going to be like your lending institutions, credit unions, insurance companies will use credit reporting, and so will your electricity. Like We Energy's Alliance, they will use that. So what I mean by using untraditional is your cell phone, cable, sometimes car insurance. Those don't typically report, but it's still a monthly bill that you're making. So sometimes we're able to use a statement from, say, your car insurance to say, yes, this person has been with us for the last 3 years and never missed a payment. So we can use that, and that's what's called untraditional credit. So that can help you establish.
Would you ask a student perhaps for an untraditional credit report, or should they be proactively saying, can I offer a cell phone bill or something?
Sometimes it's a little bit of both. A lot of what my job is to counsel people when they come in, especially if they don't have a lot of credit, because there are certain types of loans that will require, say, three credits to be out there. If you don't have those 3 credits, how else can we get to those 3 credits? And that's when we'll sometimes suggest the untraditional credit. So, but it's certainly something that someone could get prior to coming in and applying for a loan. They could call their insurance company or their cell phone company and say, can I get a printout of my payment history? And bring it along with them. Social media fraud. I don't think we can get away from this, but you can just reduce the amount of social media fraud that happens. I just highlight this study because there's been a 13% increase from 10 to 11. I haven't seen any statistics yet from 12 to 13, but I'm sure they'll be coming out soon. But it just said 86% of people that have a social media site share their birthday, and 45% of them share exactly, month, day, year. 63% tells people where they attended high school, 18% their phone number, and 12% their pet's name. Now, the reason that's important is those are a lot of things that people that will be used to identify you, to say, yep, I'm talking to this person. They know everything, all the right answers, as well as people use them a lot of times for passwords. So one of my jobs at the bank is to order debit cards for people, and they can pick their own PIN numbers, but I'll usually look through their information and I'll call them back and say, I really don't suggest that you have that PIN number because I can see it's the reverse of your birthday, or something that somebody would potentially be able to find out very quickly, having some of that basic information about people. So you can adjust your behavior, make sure you don't keep any receipts or bank statements that may have your whole number on it. Again, credit card companies and banks have been more diligent in not showing your whole account number. You'll see maybe only the last 4 digits, same with your social. So statements aren't as critical anymore. But if you do have anything that has your social security number on it, or a full account number, make sure you dispose of that properly by shredding it. And it can be something as simple, if you don't have a shredder, something as simple as tearing it up into a couple different pieces and using different garbage cans or different times that you're tossing it away. Make sure you review your statements. This one I see more and more, especially as we get more away from paper, because people don't even open their statements anymore. But you should look online and see, do these transactions make sense? Because what a lot of fraudsters will do is they'll have a very low dollar amount that they're putting through. Maybe it's only like $15. And what they're hoping is that you don't notice that there's $15 here and $10 here, and it goes unnoticed for an amount of time and they can get away with that. It doesn't sound like it's very big dollars, but if they're doing, maybe they've got 20 cards they're doing that to, that can add up in a really quick hurry. Change your passwords frequently. Make sure you at least check your credit report annually. You probably have heard the commercials, for freecreditreport.com. That will get you a copy of your credit report free. It won't show you your scores. You actually have to pay to get your scores. But now part of the consumer protection company is they want credit card processors to actually give you your credit score on all the statements. So you'll actually see that start to come to kind of like that minimum payment amount on the credit statements. Hopefully you'll start seeing your score a little bit more frequently and people won't be surprised by what their scores are. So we talked about creating passwords, using that common information. This was just for a little fun, guy's pet dies and he says, I guess it's time to change my password, because that is a very common thing for people to use pets for their passwords. So if you see your password up there for anything, make sure you change it. One that kind of threw me was the QWERTY. I was like, why is that? But it's just how it's lined up on the keyboard. But it's just kind of easy all the way across. So what should you do if you become a victim? So the gal who had her wallet stolen while we were in Chicago, she immediately called the police. She called as many, she called her main bank. She called as many of the credit card companies as, she could remember having that in there. What was unfortunate for her was that she had her Social Security card she was carrying because she had just given plasma and she needed to have that for that. So unfortunately, there's not really a whole lot you can do with a stolen Social Security card. Stop payments on accounts. Sometimes it's even getting a different license, so you have a different licensing number. The information on your license is going to change. So in conclusion, I'd just like to say that the safest way to double your money is fold it over and put it in your pocket. So, any questions that you guys have?
Do you have those?
Let me see if it, I don't know, it's not.